All right, everybody, welcome to another episode of Make Money Count. I think we are hitting our stride right now, and we're going to start bringing content to you again on a weekly basis. So I figured we would finish off the week this week with a little bit of a recap as to how the CPI numbers that we saw come out and the federal budget are going to impact interest rates for Canadians on a go-forward basis. I had the opportunity to do a presentation for a great group of realtors this week, and I put together some of these slides. So I figured, why not share the slides with you, our lovely YouTube audience and podcast listeners. We've got a couple slides I'm going to show, and we'll start off explaining the CPI number and what the CPI number means for interest rates. So how the Bank of Canada is going to interpret it, how the market interpreted the CPI number, and then what that effect on interest rates is going to be. And then we can talk a little bit about the budget, and maybe we can even talk a little bit about how the difference between the United States and Canada in their response now, in how they're going to be dealing with interest rates, is changing. Let's start with the CPI number. So CPI came in at 10 basis points higher than the February CPI number. And at first glance, that may appear to be kind of perilous for this path that we're on to start decreasing rates in June, as most economists are projecting. Within that CPI number, there was some really good information. So the first thing I will say is that the 10 basis point increase in CPI from February to March shouldn't really concern people, because a lot of it comes from the kind of main culprits that we've been seeing so far, right? Gas prices and shelter costs. On this slide, you can see gas prices were up 4.5% year over year. The instability in the world is leading to higher oil prices. Higher oil prices are leading to higher gas prices. And that is reflected in the CPI number. So I think we can kind of strip that out for the purposes of our conversation, and it will add more fuel for the Bank of Canada to be able to decrease interest rates. I don't know whether it happens in June or July, but it's definitely happening. I think what will probably happen is the Bank of Canada will wait for the next CPI report. They're going to want to see what April numbers look like. And if April numbers come in at kind of 2.8, 2.9, we will have a rate drop in June. There are other data points that are going to come out in between now and then that may influence that direction one way or another, and we can monitor that in the CDOR chart, which we're going to look at in a second. So the Bank of Canada has another opportunity to look at this information before the June meeting and the June decision. So the next CPI comes out May 21st. When that comes out, we'll have a better indication as to what's going to happen in the June meeting. So far, when the numbers came out, initial predictions from CIBC, Desjardins, and Bank of Montreal all held firm with a June rate drop. When we flip to the next slide. For all of us that are wondering what's going to happen with mortgage rates and property values, this slide is rather telling. Shelter costs increased 6.5% year over year in March. Shelter costs are influenced by mortgage interest and rents. So annual growth for mortgage interest was 25.4% year over year. And you can see on this chart that blue line. So it's coming off a little bit, and that's just because our year over year numbers aren't as dramatic. But it's still a really big number, and that's what's hitting Canadians the hardest right now. I don't have to tell you that. That and rents. The fact that rents can increase 8.5% year over year is also pretty telling of the trouble we're in from a kind of housing market perspective. And again, the Bank of Canada's fear is that those shelter costs kind of continue to creep up, because if they drop interest rates, property values increase, and the cost to service more of a purchase price, even with less of an interest rate, continues to climb. And that's scary for the Bank of Canada. What I found really interesting in the CPI number is the replacement cost. So the cost to build another home is decreasing. To replace the home that someone is living in, the home or the condo, is decreasing. And that's decreasing for the last couple months. The month before, it was like 1.5%, minus 1.5%. Now it's minus 1%. We're giving back a little bit of that on this CPI number, but it's still telling of an environment where the input prices for construction are decreasing, and that's disinflationary. So there are some indicators in the CPI number that are going to be helpful for the Bank of Canada that I'm sure they're tracking. Okay, this slide is straight off the Bank of Canada's website, and you can see there is a band on this slide this band, this little band in the middle, it's like a gray band. That is the target range for where the Bank of Canada wants to see inflation. You can see how high we got during the COVID period and how we are now getting into that band. What is very telling about this is that there isn't just one CPI number, right? There's something called core CPI or CPI trim, where the Bank of Canada takes out certain goods that are in the CPI basket in order to reduce some of the volatility in the month over month, year over year numbers of CPI. And the core and trim CPI numbers are what the Bank of Canada tracks. So if there's anything extraneous that impacts certain items in the CPI basket, they're taken out. It shows you kind of a more pure indication of what's happening with inflation. With respect to the core CPI, for the last 3 months, we've been declining. And that is very important for the Bank of Canada. In their statements to us, they tell us how important that number is. So I think Tiff Macklin's going to be really, really happy to see yet another decreasing core CPI month. This slide's probably less positive for our perspective of getting a rate drop in June because it says that Canadians are optimistic about real estate prices. And this came from a Nanos poll. It shows you as soon as the pandemic started, confidence just fell off a cliff and everybody was super worried about real estate prices. They were worried about what their house was going to be worth. They thought real estate was heading into the toilet. And the exact opposite happened, as we now know. Real estate prices boomed because everyone had free money and everybody wanted to buy a bigger house because they figured they'd be working from home forever. Then when the stimulus was removed and inflation came in and interest rates started getting hiked, confidence fell off a cliff again. You can see that evident kind of like at the end of that gray box there in this chart. I got to get better at pointing to this chart, but like kind of like at this part here on the bottom of the chart, you can see where it dips off. And then since then, it's been a bit of a steady climb back to confidence. That's a result of the Bank of Canada telling us interest rates are going to come off. So the worry here is, and we touched on a little bit with the CPI number, the worry here is that Canadians, are we all just kind of waiting at the start line now of a race, waiting to hear something positive from the Bank of Canada with respect to dropping interest rates to go out and start buying real estate again? Bank of Canada would be scared of that because it would continue to drive up real estate prices. And again, the shelter cost would continue to stay elevated. There's such a great portion of consumers' disposable income that they're spending on housing, that's a negative drag on our economy. So optimism, not great for the prospect of seeing rates get lower. Let's go to the next slide. This is my favorite slide. Okay, so, and it's so rare that this happens. So to give you a little bit of perspective, the day that the CPI numbers came out this week, Tiff Macklin and Jerome Powell were together at some type of fireside chat in Washington. You weren't invited. I didn't get invited either. But you could read what they had said. There were minutes of this fireside chat. It was very well covered and heavily reported on. So I extracted 2 comments, one from what Tiff said and one from what Jerome said at the meeting. And you're allowed to call him Jay, actually. He said that at the meeting. And it shows you how diverging Canada and the United States are right now. So Tiff says measures of core inflation did tick down again, and that does suggest that underlying inflationary pressures are continuing to ease. He even said in previous meetings of the Bank of Canada that we were looking at a June cut. So he's clearly biased to cutting interest rates. Whereas, and we spoke about this in our last podcast, the United States is seeing economic growth. Like they had blockbuster employment numbers. The S&P is climbing to all-time highs. You know, there's other macroeconomic influencers like, is China coming back online? Is their economy going to start to strengthen? All of these things are positives for the American economy. So what does he say? What does Powell say? He says we need greater confidence that inflation is moving sustainably towards 2% before it would be appropriate to ease policy. The recent data have clearly not given us greater confidence and instead indicate that it is likely to take longer than expected to achieve that confidence. So the 2 takeaways for us on these 2 diverging comments should be, number 1, your travels this summer are going to be more expensive because the Canadian dollar is going to be significantly weaker. We've already seen it weaken and it will continue to do so under the prospect that Canada will further reduce interest rates and the United States will not. We're going to see the dollar drop again. So that for our purposes isn't necessarily the most critical piece when talking about interest rates, but it will affect how the Bank of Canada behaves. The Bank of Canada can't start wholesale cutting interest rates while our major trading partner to the south does not. It will impact the pace at which the Bank of Canada can start to drop interest rates. So we got to be cognizant of that. We should watch for that happening. So there are a lot of inputs right now for the Bank of Canada to contemplate as we look towards what we're going to see for the prime rate and our borrowing rates as Canadians. Why don't we look at the TMX CDOR chart, our favorite chart. I'm going to show it to you from a different angle today. Again, this is a great indicator of what is going to happen with interest rates, what the Bank of Canada is going to do. And you can see if you scroll there, if you can see on the top corner of this, we are looking at about an 86 percentage point probability of a 25 basis point drop in June. Again, if I was betting, I don't know if I would bet an 86% chance. I think that if we were to include July, because there's a meeting in June and there's a meeting in July, I think by July, we're probably going to get that 25 basis points. And if you want to see what it looks like for September, so in September, they revise it to a 75 basis point drop, but they put a really ultra low probability on there. That means that it's all but 100% chance right now in this market, the expectation that we're going to see a 50 basis point drop by September. Again, right now, the market's not necessarily pricing in a full 100 basis points for 2024. That's going to be dependent on all of these factors that are influencing the Bank of Canada. We can quickly jump over and look at the bond yields. Okay, so here are the bond yields. Since the start of the year, we've been steadily increasing. And that's, again, it's a result of this expectation that the Bank of Canada isn't going to give us a full 100 basis points decrease in interest rates in 2024. And as a result, we're seeing that 5-year yield creep a little bit higher, closer to that 4% territory that we've been in the past. I think that as the market plays out, we'll see this 5-year yield continue to slide. When we start seeing some of the Bank of Canada rate cuts, we'll see this come off a little bit. But for now, it's still a little bit elevated, especially from where we remember it in the kind of golden 2020s of borrowing. All of this is to say that there is optimism in the market, and that optimism is fueling higher probability of fewer rate hikes over 2024. And these two things kind of counterbalance each other. I think that we've got a lot of data that we can continue to see. In the meantime, Canadians are kind of trying to figure out whether they should be locking into a fixed rate or taking a variable rate. I can tell you, shameless promotion of Cannect, that we always have the lowest rates on the market. And I remember that because I was looking at our Instagram account where we started posting some of our rates, and we currently have, I think, the lowest 5-year fixed rate anywhere in Canada. So if you're interested in figuring out whether you should take a fixed rate or a variable rate, and then you also want to get the best one, Connect's a pretty good spot to do it. So listen, if you're looking for some advice right now, like many, many people are, on whether to take a fixed or a variable rate, there are so many things that are going to affect it. Another thing before we go is the federal budget. This week we had kind of like a double whammy, right? We had CPI and the federal budget. And I think that that budget is going to have an impact on rates. As much as our Minister of Finance and our Prime Minister toured around the country and explained that, they didn't want to make the Bank of Canada's job any harder, they've added $50 billion worth of spending. And number one, that affects inflation. Number two, someone has to pay for it. I can tell you who it's going to be. It's going to be Canadians, right? We saw in the budget, they announced that the capital gains exemption is decreasing. So whereas before you would pay tax on 50% of your capital gain, that's now increasing to 66%. I know that in the budget and in the press release, the government of Canada would have us believe that that's not going to impact anyone but the top 0.001% of Canadians. It's simply untrue. It's going to affect anyone that has a cottage, anyone that has a rental property, anyone that has a second home. It's also going to affect anyone that works in an industry where people are creating companies and creating jobs. We've already seen people in the tech industry explain that it's becoming far less economical. It doesn't even make sense to start a company in Canada with these capital gains taxes increasing. So it's really unfortunate the direction we're going. And it's unfortunate that all of this spending, this inefficient spending that's being brought into the market under the guise of increasing affordability for homes is just going to drive up our taxes. And in the end, I hope that we can dial back some of this, but I don't know. Anyways, we're going to leave it there. Thank you very much for watching or listening or however you watch these podcasts. And if you don't mind, hit like, hit subscribe, and in the comments, anything you want us to talk about, put it in there. Thank you very much.